Hey, good afternoon, and welcome to the second half of a special Financial Perspectives, which is Foster Group's regular series on things that we think are of interest to investors and clients. Today, we're going to be talking to Matt Moklestad here. We'll be continuing a conversation that Matt and I had about ESG investing. ESG investing has been in the news a lot recently, over the last year or two especially, as leaders of corporations are being asked to produce more than just financial profits. Both shareholders and the government seems to think that corporations should have their eyes on more than just a financial bottom line, but to consider what kinds of things they're doing that impact the environment, that impact society, and the kind of governance structures are going to help them to have positive results kind of across those shareholder interests. In the first part of our discussion, Matt and I talked about more the definitions of ESG investing and kind of the theory and the way to measure certain kinds of ESG impacts. In this part of our conversation, we're going to continue by talking about how you can practically implement an ESG strategy and how you'd go about thinking about your own goals and how they fit maybe in your personal portfolio strategy or in your institution's portfolio approach. I hope you enjoy the second half of my conversation with Matt about ESG investing. So we have all these different categories. I'm looking at the responsible asset selection part of the picture here. And obviously, there's a lot of ways to measure what a company is doing and how they are doing at it, if they're doing good or bad, or what kind of their impact is. That makes it a little more complex for an investor, right? Because it's hard for us to personally score a company versus another company. So how does an investor implement this thing, and who's helping them to score or to monitor the actual behavior or performance of these companies that we might or might not invest in?
Yeah, so how do you actually get from ideas to actually getting a portfolio?
Yeah, exactly.
So there's probably different layers of depth to this question. The first one is, the first way to do that is using a broad investment like a mutual fund or ETF and simply just adopting someone else's view and scoring methodology on these topics. So a couple large sustainable data companies would be like MSCI or Sustainalytics. And so they measure companies based on ESG factors, and they do it by sector too. So say an energy company would probably have a score more highly rated towards the environment, so the E, where a bank might have more rated towards the social and the governance aspects. So they kind of create leaders and laggards in each sector. So you can simply just adopt that view using a pooled investment vehicle like a mutual fund or an exchange-traded fund. And for many investors, it's a very cost-effective way to kind of take that first step into integrating some of these issues and factors. To go a layer deeper, so a mutual fund or an ETF, so it's one ticker and you hold a range of different companies underneath that ticker. You can actually implement other types of investments like a separately managed account where you would actually hold, so you say the S&P 500, all 500 companies in your portfolio. So you'd see each of those tickers. And the thing that allows you to do is get much more customized in, okay, are there individual stocks you don't want to hold, or are there certain sectors you want to exclude? So you can get pretty customized using an SMA structure. The minimums are often a little bit higher for those types of investments, and depending on assets, it could be a little more costly to do that, depending. But those are a couple ways. So broad SMA, and of course you can always, if you love an individual stock, you can always purchase that on the side if you want. But those would be kind of the first ways to think about, or the primary ways to think about how you might implement ESG factors. Make sense?
It totally does. I think on that fund side, when we think about, so let's use MSCI as the data provider, it's not that MSCI is actually even producing all the funds, but other fund companies are using MSCI's scoring method, and they're actually building and making funds available, ETFs and mutual funds, to individuals who want to kind of buy into different ways of using their scoring methodology. Same thing with FTSE, another company that does the same type of thing. You mentioned Sustainalytics. There are just a variety of companies that are providing rankings and scoring, and then fund companies or exchange-traded funds, they're produced to say, we're going to use this scoring methodology to create a pooled vehicle that then individuals can buy in, kind of one investment gets them a broadly diversified portfolio based on that scoring methodology. In that SMA type, things are a little more interesting or maybe a little more complex, because there you're going to say, well, instead of buying a fund that's put together for me, I'm going to say, this is exactly what I want in my
Yep,
portfolio.
exactly.
However you get to that exactly determination. Matter of fact, individuals can license data from MSCI to build their SMA account. It's just that SMA manager then will come in and say, okay, we're not going to just go out and buy you a fund that everybody else is buying. We're going to actually buy all the individual stocks according to the weights based on the scoring methodology that you're picking. So you might have a portfolio. You mentioned the S&P 500. Your portfolio might have 400 individual stocks in it.
Yep.
Because 100 of them are screened out and maybe they're weighted differently than the market. But it can be a pretty big set of holdings if you wanted that kind of precision.
And a lengthy statement. That's a long statement.
Yeah.
Too. You hold 400.
That's right. When you get your mail, hopefully you're getting electronic statements at that point, right?
Exactly.
Yeah. So one other thing we've talked about is this is a ways to invest dollars, but there's other ways to implement this idea of kind of an ESG approach. We've talked about this, the beyond the portfolio. Talk a little bit about that.
Yeah, I'm glad you mentioned that, because I was going to come back and say one more thing, Kent. And that would be exactly that. So we encourage all of our clients to think about how might you integrate this just beyond your portfolio. So what boards or nonprofits are you serving on to advocate for those things that are most important? Also, how do you spend your money? That's another big one too. So yeah, it's not just in your investment portfolio. Like this is, when you talk about someone's values, that should be all encompassing. So we encourage people to think about that aspect too.
Yep, I think that's just good to remember. We have a lot of options available to us. Okay, so we're building these portfolios kind of based on views of what's important, our values approach. But as an investor, we want results, right? At the end of the day, we'd like to get some returns.
You got to get a return, yeah.
We hope so. Some returns that are going to help us to meet our goals. And we want to manage risk along the way too. So when we think about this kind of investing, what are the performance and risk management implications here?
Yeah, you said it. You got to get the return you need and reach your goals, right? So when it comes to performance or risk implications, the first thing I'd say is that, well, the verdict is still out to some degree. So a lot of the publicly available data, although it's getting longer and longer as time goes on, we still don't have a lot. When you think about the long range of history we might have for other indexes like the S&P 500. So in some ways, the verdict is still out. When you think about kind of views on what the implications could be or are, as always, there's kind of two sides to that camp. One would be favorable and one would be unfavorable. The favorable side would say that, well, better run companies that do a better job with the environment, with social issues, with governance issues, they're better companies and they should perform better. And investors should invest in those, have a desire to invest in those companies and push up that price. So there's a favorable view, and then there's an unfavorable view where okay, anytime you decide to exclude something in your portfolio or overweight something in your portfolio, you're increasing your risk, where your concentration risk, where you're holding more of something relative to a broad market. And also, you might have a company as well that is doing a fine job. They're producing good results, but they might be just inadvertently penalized by market participants because of some of these issues, where in other ways they might be totally fine. So it could create more of a value and type of investment because of that. Is that making sense?
Yeah, I think it is. I think when you're talking about a company that's getting penalized, what you mean there, what you could mean is, hey, if a ratings company says this company is scoring poorly on governance, then what happens is money could flow away from that company. When money flows away or it's less favorable, the story is the price will go down. The thing is, that company may actually produce some pretty decent financial results because they do make a good product or something that people need. And so as that price goes down because people pull out, you may be missing an opportunity to buy a company at a discount. Because later on, when that company produces a good result because the product is good and they sell a lot of it, price goes up. Like, well, I missed that company because for other reasons I didn't own it. So I do think that diversification one is a real risk and one that we want to talk about. But I also know you've kind of done a little research, and we've talked about this as well. So far, it's like that risk-return balance seems to indicate that, well, investors who really want to invest this way, they can get a pretty good
Yeah.
market-like return. So
Yeah.
tell us a little bit about that.
Yeah, well, I'm going to show you just an example here. I'm just going to use one of the kind of the longest running funds. It's a very large fund. There's about 14 billion in assets in this. It's a Vanguard fund. And this would be, as always, there's a number of different approaches. This is probably a more broad-based approach where you try to get a fairly market-like experience while also integrating those ESG factors.
Yep.
So this is the Vanguard FTSE Social Index Fund, and it goes back to beginning of 2003, and I've just compared it to the S&P 500, which is the lighter tannish colored line. That Vanguard fund is in the green. And you can say the first thing is like, well, they ebb and flow, they move together,
Yeah,
pretty close. I mean,
Yep.
there's not a lot of difference there. If we look at the long-term kind of common inception, really similar results. That FTSE, that social, the Vanguard fund is a little behind that S&P 500, but you're getting really similar results over that long-term period. And it's interesting to note that they're almost identical over the last 15, and the social fund actually does a little bit better over the trailing 5, 10, 3, and 1 year periods. So like most investments that have any sort of difference, you're always going to have periods where one does better than the other. But I think kind of the key thing here is that you can integrate some of these factors at a broad level and have a pretty market-like or good experience.
I like that. It kind of reminds me of what you said earlier about the length of time, because we know we have S&P 500 data going back to 1926. So we don't have that kind of length of data. And if any of you have ever talked to statisticians at all, you know that they would tell you the more data, the more observations, the better. And in this case, we just have fewer observations of an ESG kind of based investment versus the market as a whole. But if you looked here in the last 20 years or so, you'd say, looks pretty similar, which I think is encouraging
Yeah.
for investors who
Yeah.
want to say, I'd like to move in that direction. I'm a little concerned about performance. They could look at something like this and say, at least in larger, very liquid markets like
Yep.
the United States, it seems like it's possible to implement some of these things and have a very similar market-like experience, which is great.
That's right.
Okay, so we've looked at some data. We've talked a little bit about implementation and how this might work. When Foster Group or an advisor is working with an individual, whether it's an institution or a family, to think about, okay, how might they personally go about this? And how does Foster Group advise people? This is kind of the rubber meets the road
Yeah.
question, Matt.
Yep.
How does that work? What does that conversation look like?
Yeah, so I'm going to just use a little personal illustration here. So my wife and I, we have a number of kids. We have 4 kids. And like any good parent, I know you're a parent, Kent, I desire my kids to grow to be successful and to reach their own goals. And in order to help them do that well, I have to know them. I have to know them really well. And the reason I share that is because it really gets to the heart behind how we work with clients here at Foster Group. We start by knowing them, because every investor, whether it is an institution or in a family or an individual, they all have their own definition of what success looks like. And they all have their own view on these issues, social issues, governance, environmental issues. So that's where we start. We start there with our clients, but knowing them. And in those initial conversations and ongoing conversations, these things come up. And it's really neat for us to be able to be in a position to, one, all of our advisors are knowledgeable about this topic. We've talked about it a lot, to have that conversation with them and what it might look like in their specific situation, how we could implement or integrate some of these factors in their portfolio.
I think that integration word is a great one. When we started talking about this a number of years ago and how we might do things at Foster Group, 2 of the words we used a lot were the words advocate and accommodate.
Yeah.
And I think what's important when you're working with an advisor of any kind, what you hope for is that they won't advocate for what they believe in values-wise as much as they'll want to understand what your values are, and then find ways to accommodate or build structures, build plans, build investments around the things that are important to you. So they're adapting, they're accommodating their approach to make sure that your kind of goals are met, whether it's the financial risk return goals or whether it's actually some social values kind of expressions that you want to make. So, it's not like the people at Foster Group don't have views and, that we would advocate for in some situations, but it's really not the role of the advisor to over advocate, to try to replace or put their kind of moral and ethical views on clients. We try to keep that really in mind when we have conversations. I think that gives us a great opportunity to work with a wide variety of
Yep.
clients because, as you said, Matt, everybody has different views of which part of the E, which part of the S, which part of the G
Yep.
is really important to them.
I cannot agree more. Yeah, as a fiduciary to our clients, we are there to advocate for them in every single way. So I couldn't have said that better, Kent. That was great.
So anything kind of, we're going to wrap up here in just a second, but just in closing, anything that you'd want to kind of say in summary, hey, investors thinking about this, here's where you start.
Yeah. Yeah, it's great. So for institutions, so if you're a nonprofit or endowment or foundation, probably the best place to start is just having a conversation with your investment committee or finance committee, whoever has the oversight of your investment portfolio, and just have a conversation of what it could mean like for your organization. For an individual or family, it's starting right where right in the conversation we just talked about with an advisor. So just having the conversation and bringing up the things that are most important to you when it comes to your investment portfolio. So that would be really important. If you are a foster group client, just talk to your advisor. If you're not working with foster group currently, we'd be more than happy. I know you would, just to have a informal conversation about what this could practically look like for you. So,
Yep. Really interesting topic. I mean, this is one of those ones, there's been a lot written about it. There'll be a lot more written about it to come. We could continue to talk about it. We probably will in the future have more discussions around this. I think kind of for me, the wrap up would be whenever I think about working with a client, an investor, financial plan, whatever it is, you always start with goals. Goals are first and kind of tools and strategies are second. So
Yep.
we've talked a little bit about different ESG tools and strategies, mutual funds, ETFs, separately managed accounts. Those things are all super interesting, but the most important thing is to make sure the goals are well defined first, and then picking the tools that are going to work best to accomplish the goals that are important to you. As Matt mentioned, at Foster Group, we love to have these conversations with clients and people who might not be clients yet, but might like to have a conversation about how Foster Group would help you over time. At the end of this, there's going to be some contact information on the screen to show you how to get a hold of Foster Group. Love to take a phone call, love to create a video meeting, love to meet in person, whatever works for you. We welcome those conversations. We look forward to them. And Matt, thanks for preparing all this information today. I know it's hard to kind of parse it, bring it all down, but I think it's been helpful. If you have any more questions, please let us know. Until we see you again, thanks, and we'll see you soon.